It's been a weird week. For starters, the US was expected to run out of cash by June 5th, this Monday. It got so bad that Secretary Yellen wrote a letter to the White House pleading for a deal to raise the $31 trillion debt ceiling and avoid a US default. If Congress wasn't able to work out a compromise, there would be major hits to programs like Social Security, Medicare, and veteran funds. Last week, the Treasury Department only had $38.8 billion in cash, which is just simply not enough to meet all of its financial obligations. In the past, treasuries were seen as the ultimate safe haven asset of the global financial system. If there was one country that you could trust with your money, it was the United States. But as we approached June 5th, with no deal in sight, lending your money to the US government was suddenly deemed risky. Yields on Treasury bills were well over 5% and even closing in on 6% APY. Short-term cash management bills also peaked. These CMBs are a good way for the US Treasury to raise a small amount of cash immediately, but some of these needed 6% yields. This was a sign that investors required a large risk premium for lending money to the United States. In the credit default swaps market, countries like Germany were rated way higher than the United States in mid-May. Holding these supposedly risk-free assets was simply just not that attractive anymore. And here on YouTube, I even had plenty of comments from viewers understandably worried about a potential default and what that meant for their Treasury bills and their I-bonds. But over the last 2 days, we had some really good news. On Wednesday, the House overwhelmingly passed legislation aimed at suspending the debt ceiling, and credit to both President Biden and Speaker McCarthy for drafting it. They were cutting it a bit close, but it passed with a vote of 314 to 117. Of course, not everyone is happy about this deal. Both sides made major concessions, and there are plenty of, say, more extreme politicians who are incredibly angry about this deal. But at the end of the day, it moves on to the Senate. And on Thursday morning, there were still a lot of critics, with some wanting to amend the bill, which would send it back to the House and restart the whole process. Thankfully, though, they stopped screwing around, and eventually the bill was approved with a vote of 63 to 36. It's a monumental achievement because Congress has successfully averted the debt crisis. And as of the making of this video, President Biden still hasn't passed the bill yet. However, he is expected to this Friday night, so by the time you're watching this video, things might be a-okay in the US government. And when the bill passes, Treasury bills and I-bonds will probably be seen as a relatively risk-free asset again. We maintain our decades-long history of no defaults on our debt. So good news. That said, because the risk premium would fall, I'd expect Treasury yields to also drop over the next few weeks. But in the meantime, I'm still buying US Treasuries. Earlier this week, I actually put $5,000 onto a 5.2% T-bill maturing in just 4 weeks. The risk premium is still here, so I'm looking to take advantage of that as much as possible. And truth be told, I'm still very comfortable buying US Treasuries so long as yields remain over 4%. Now, if that's not the case, I'll probably look at high yield savings accounts and bank CDs. I'm actually going to buy some CDs by Marcus by Goldman Sachs, so if you're interested in learning about those more, definitely stay subscribed so you'll see that process. But as always, love to know your thoughts and have a great weekend. Have a good one.